Welcome to Mutual Fund Mantras. It's a series in which we decode markets and events for investors. I am Monica Hallan, consulting editor with Mint, and we are talking about the big bounce back that markets and the economy have seen in the past few months. But investors are really worried about what this means for their money. Should they stay invested? Should they exit? What should they do? This is what we are debating today on the topic strategies to invest when markets are at a lifetime high. I have a very eminent panel with me with Dr. Harsh Purohit, Professor of Finance and Dean, FMS Wisdom at Banasthali Vidyapith, and Mr. A. Balasubramanian, MD and CEO of Aditya Birla Sun Life Mutual Fund. Thank you for joining us, gentlemen. Welcome to the panel. I want to start with you, Bala, and ask you this question that when we look at the revival in the economy, when we're looking at the RBI numbers which are projecting, the slowdown is less worse than what we had thought. And the Q1 FY22 numbers are at a growth of 21.9 average. What are we looking at? Is this just pent up demand? Or do you think this is actually going to sustain, Bala?
Yeah, I think interesting, Monica, the way the market has given a bounce back in the last 6 months, as you rightly put it in the initial remark, that market touched a new high. I think it's largely coming on the back of one, first and foremost, the regulators in the last 6 months reacted to the new normal and took all the steps that would help in keeping the sentiment alive. And second is, as and when the market picks up, the economy picks up, we have the right policy in place, whether it's with respect to interest rates, whether it's with respect to the forex policy, whether it's with respect to the push that's come from the government in the form of stimulus. All such things are in place so that when the now new normal come back, post-COVID getting over, we'll see that pick up coming in. So I think initially in the month of April and May, most of the companies did react negatively, not knowing about what will happen to their own business model beyond June, pure on the basis of the pent-up demand things. So July was considered the pent-up demand, and nobody was expecting August to be better than July, and same thing which was September better than the August. And that something was the perception that most of the people used to carry, including the business people. Whereas in reality, that continued in terms of sales, whether it is on two-wheelers, on car sales, or commercial vehicle sales. In fact, in the month of October or November, the commercial vehicle sales have been better than the previous month, which essentially means to make people believe that while it was seen as a pent-up demand, therefore one has to watch and see whether it is going to be sustainable. The way I think the policies are in place, the way the interest rates are behaving, the way I think the macro is also being supported by the good monsoon output coming from the rural sector, and also the continued reform that is coming from the government on various initiatives, seems to be making a case for not the pent-up demand to be the only driver. Even the normal growth rate also to come back as we move into 21, 22. So that something seems to be playing out quite nicely. And therefore, I would assume that the projection is coming from both the Reserve Bank of India as well as by the government. Even the global predictions have been coming better for 2022, especially for the emerging market. And within the emerging market, in particular to India, the growth expectations are gaining momentum, pure in the base of what I just mentioned in terms of macro development that we have seen in the past, but not sure about what the level of impact it could have on the economy. But in real sense, the impact seems to be getting better each day as it passes.
Okay, that is very, it's a good hopeful thread to build on. I'm glad you're not feeling hopeless. But Dr. Purohit, when an academician like yourself looks at data, you would be probably trying to get a trend line to see how the economy was performing before. I mean, the last financial year was very bad. It was just a 4.2. we really did not think that the numbers was so bad, but finally, when we counted, it was 4.2. How do you decode some of these events? So, yes, the government has done a lot, but how do you think the road ahead looks?
Yes, I completely agree with Bala Subramanian ji, and the things really look much brighter. And I recollect that around the month of May, when IMF had given some projections, that time the outlook was really very scary. And just a few days back, IMF has again said that now it has changed its opinion and has mentioned that the Indian economy is recovering and it's on the growth path. So that is very nice. And if you see the IIP and the manufacturing PMI figures, they are also in the positive territory. And more importantly, they have beaten the expectations. On top of it, owing to the global liquidity, our forex reserves are also rising, and the outlook is definitely very optimistic as of now. But what I feel is that there are five things which are crucial here, which we need to have a look when we talk about the economy and the market as the things go by. The first is the dollar index. So if you see the 5-year trend of the dollar index, then its peak was about 102.3, and a larger time the dollar index was above the 95 level, and now it is about 90.8. So last 1 week the max was 93 and the low was 90.5, and it is expected that we can go even to a level of about 88, 89 in the time to come. So short term, you can see that the market can really go up. So first thing is the DXY. Second is if you see the Morgan Stanley's emerging market ETF data, then the 5-year data, if we see, then it was 2018 when it picked up at 51.03, and last 3 months it has been rising, currently at 50.84. That also might go to about 54 levels. So that's the emerging market ETF giving very positive signs. Third, Monica ji, is the Nifty. If you see, there has been a steady rise, and in fact almost 1800 points rise recently, and other markets are also in line with this. So it's very heartening, because from the level of 7511 in Nifty which we saw, things are much brighter. So that's the third thing, makes me optimistic. Fourth is of course the IIP and the manufacturing PMI. And finally, the rupee, if you see, has been showing the signs of strengthening, and the bad time in April 2020 when we had seen the 76.5 levels. Now we are to 73.8, and who knows, we may reach 70 very fast. So on the whole, things looking very positive, and the economic downturn, I would say that we are almost out of it.
Right. No, that is very heartening to hear. Bala, my question really is that the first data which came out, and now we have been able to analyze the corporate reports results, it's looking like a profit-led growth, because margins are high because costs were cut fairly brutally during the lockdown period and afterwards. For instance, real estate costs are down, wage bill has really suffered. So I think everybody, the first thing you did was cut the flab in your organizations, and I think everybody has suffered because of that. So you can have better profitability, but unless the wages go up, we will have a demand problem. So how do you think we can get out? How do you stimulate demand? Because now I would imagine that to stimulate demand, private sector will have to start its capex. But is that happening? Are you seeing that?
I think interestingly, I think on this capex part, Monica, our own group was in the infrastructure space, which is cement. They are the largest cement manufacturing company in India. Recently, it announced close to about 5,000 crores worth of capex in building cement capacity. It's the first corporate announcement in India that has come in building our capacity, in building up new capacity to meet the future demand. So that's something I would assume it is just a beginning of the corporates start looking at capex as one of the area of building their future. Maybe it's too early to take a call that many corporates will follow that. But the fact of the matter is, it has been announced last week. Means there is somebody that actually is looking at beyond 2021, 2022, not all building capex. That's one. And second is clearly, if you look at the cost of capital today in India, as these now become the lowest, given the fact interest rates are low, and overall the equity money is also being available. So therefore, unlike the past where the cost of capital for setting up any new businesses used to be very, very high, and as a result of that, the IRR are expected on project capital cost also now is looking better than what you would have seen in the past. So in that sense, there is a merit for everyone to look at the capex as cycle. But having said that, I don't think the measurement of the economic growth can be linked only to the capex. At the end of the day, we have a price stability. We have an ability at this point of time on the basis of the current capacity that we have to meet all the demand that comes in. Therefore, supply demand gap is not very large for somebody to go for a capex. I think probably the demand has to pick up. I think the demand drivers is the one which is being driven by rather than looked at by the government. One, the high hope is now being built, which in my view will also become a reality, which is driving the whole demand growth through the rural economy. Given the fact that high level of focus on agriculture, and also the agriculture output this year is better than the last year, and high level of focus that has now been brought in by the government on agriculture sectors also would bring in high level of output coming from the rural economy. Therefore, it comes from there. Second, of course, the job creations will have to happen, but I think one of the area in my view, the government probably would step up, which is high potential for creating jobs, as well as creating the demand for ancillary sectors related to the housing sector. And the very fact that every state government today has cut the stamp duty to as low as about 2% or 3% in order to boost the demand. Also, the central government has also taken a call to bring down the rate that is applicable for the stamp duty versus the price that is being put out in the register office. Both are, I think, now we can have a variance of about 20%. So all such minor irritants which are also holding back the demand to come back is also now been removed. I would assume in the last 6 months, the way the government has removed a lot of the small irritations, pain points related to the various policies that were actually holding back the demand, I would assume such initiatives that have been taken by the government would bring back the demand growth as we move forward.
Right. So what I'm hearing is that instead of going for that big push, 10 trillion, 10% of the GDP push that demand was coming from a lot of commentators, especially from abroad, what I'm hearing is that the government has removed smaller pain points through the entire system. And that makes you hopeful that possibly there would be a demand resurfacing happening soon. Dr. Purohit, how do you look at this whole demand equation? Because if wages have been so drastically cut and we haven't seen that kind of fiscal spend happen right now, so there has been, the government has done a lot of work, but the kind of fiscal spending that will stimulate demand we've not seen. How would you look at this equation?
Yes, you are right, Monika ji. The kind of fiscal spending that was required, it is not up to the mark right now. But we remain quite hopeful, and I think the recent RBI policies, that documents that we have seen, and plus there is a hope that the next budget is going to be really bright for the economy. Yes, there are constraints as far as the demand is concerned, but I think if we look at, again, if we go back to April, May 2020, and then have a look at November, December 2020, we find that things are definitely better. So I think we can remain quite hopeful on this. And also some days back, I was hearing to the SBI chairman who mentioned that there is cost cutting, but at the same time, there is more maturity that we are finding in the market and in the economy. So on the whole, time to come, things would be brighter.
Right. So one last question on the larger piece, and then we'll move to individual investors, because that's what really everybody wants to know what to do with their money, and who better than one person from academia and one person from markets to answer. Bala, how do you look at the budget? Is this really going to be that bounce back budget, the growth stimulus? Because RBI governor himself said it's a no-brainer.
Now, interestingly, Monica, I was just thinking on the budget just about a few days back. While not many are building on expectation of the budget, again, this budget, probably the way the finance minister has been addressing various issues since the time she took over as a finance minister, and even the public forum when she addressed after the last budget, related to the capital market restrictions, whether it is the long-term capital gain tax, or with respect to dividend distribution tax, or the withholding tax, and actually building up a REIT and InvIT. And if you look at all these taxes that has been imposed on these items, have not been yielding much success to the government in the form of giving them a huge inflows in the form of tax collections. At the same time, they also remain as a minor irritant from the consumer's point of view, from the investor's point of view. In order to actually bring in high level of resources to actually go after REIT and InvIT, because that one builds an alternate source of financing for the government in terms of taking out the existing projects so that the money can be released to put more money into the incremental money into the other projects. Therefore, these are some of the things, in my view, could be addressed in the budget, including the capital gain tax. Well, of course, nobody is actually against the capital gain tax. At the end of the day, the government has to also look at it. By having such taxations, does it give me billions of dollars in the form of revenue, or it gives me a $1 billion, which is not significant enough for me to have such kind of clauses. Therefore, I would assume the government is quite mindful of something which is there as a part of the budgetary provisions as a jewelry kind of things, cosmetic kind of things, or such thing can be removed so that the small pain points are not being represented by the industry forums like AMFI or CII, and we only represent the big picture recommendation of the government, and therefore the government can focus on larger picture to be addressed rather than focusing on small things. I would assume this coming budget, given the fact that the way I think government has been addressing all the pain points, would address many such small pain points related to the taxation, whether it's to the capital market or to the development debt market or to development of the REIT and InvIT market, so that the consumer, rather the savers' money can be channelized without asking too many questions, without getting too much worried about related to the taxations, and the government focused on building the big picture from the business point of view.
Right. So, Dr. Purohit, do you not think that disinvestment should take precedence this budget, because there is very little fiscal elbow room, and no one's going to blame the government for breaching the FRBM targets? Of course, they have to spend, but where is the money? So, I mean, where do you think this government will find the money to spend?
Yes, Monica ji, you're right. Disinvestment is one window from where some money can be mobilized. But I think that would be a very small part. And in fact, the government has to look for the ways in which it can boost the receipts in the form of the tax receipts. And that's the core way out over here. I don't think that given the trend that we see as far as the funds which have been raised through disinvestments, that this budget we will be able to raise much of the funds. But at the same time, if the efforts are made and there is a good conviction, then the government can raise huge amount of money through disinvestment. And if you see right now, the Nifty also touching 13,400 levels, and the PSU stocks also now started going up. So the moment government shows its conviction, then it's going to get a very good price for the jewels that it is holding, and it's going to be good for everyone.
Right. Okay. Now coming to what people really want to hear, what to do with their money. And let me just lay out the story here. There are investors who exited when the markets dropped in March, and they've been holding on to their money, waiting to come in. And every subsequent week after July, their hearts have sank because markets have gone up and up and up. So there is one constituency, Bala, which has been sitting on their money cash for a while. And they have been holding on to their money. And every subsequent week after July, their hearts have sank because markets have gone up and up and up. So there is one constituency, Bala, which has been sitting on their money cash for a while. And they have been holding on to their money cash for a while. waiting to get in. So we want to talk to them. What should they do? That's the first. Then there is somebody who is still a regular investor, but is worried about these markets. What should they do? And third, who was, the investors who want to rethink their asset allocation. So for different investors, how do you think they should behave now?
Yeah, I think it's interesting point on which we are there. Monica, I think you remember the same platform about 5-6 months back. We had the question on the reverse, in the sense that market had fallen so much, when the market will bounce back kind of things. So I think one of the things that remains as a common thread between now and then is staying invested is one common thread. So when I mean staying invested, for the existing investors, often the question comes, what should do the investment? So when my investment is meant for a longer term, and ups and downs anyway, such kind of things comes and goes. By the end of the day, fundamental catches up, and then regulator and policymakers comes and start working towards uplifting the economy, and therefore try to drive back the growth once again. Such kind of things brings back the market to a normalcy. So therefore, staying invested as a theme, I think every investor has to apply. Those who are invested. In terms of new investors who are coming on board, they naturally putting money in this kind of level, you would have a question mark: should I invest? I think given the fact that equity as an asset class goes through about 1.5 to 2 years of reasonably good bull period after every fall, the pullback generally sustains for about 1.5 to 2 years period, and then it again tapers off because your earnings will fall short of your expectations. Because that cycle, therefore, the new investors has to focus on asset allocation and then come in even equity asset class. The one other factor I think every investor has to keep in mind, if you look at the whole investable opportunities, whether it is in fixed deposit or in fixed income schemes or in real estate or in equity, are the all asset classes, if you see today in India, the interest rates are one of the lowest. And any deposit that you put, though it gives you a safety element, it gives you a guarantee on return, but the return expectations versus what you get actually one of the least. This is where I think investors have to build a conviction and confidence. Then equity, I'm coming in for longer term as part of my not just only wealth creation, even better return than my investment opportunity that is available. At the same time, focus on asset allocations. And SAP has been a single point of mantra that all of us have built. I think continue to keep the focus on SAP as a way of investing, rather than trying to getting worried about high market, low market, what should I do on those periods.
No. So these are now rules set in stone, and I think the behavior of the Indian retail investors, if you simply look at data, has been very, very mature as compared to the HNI data over time market. So I think the people who got hurt in March were really the very smart,
HNIs.
People, HNIs who exited when markets were down 25. What is your message to them? Because they're still holding cash. They have not come back into the market. What is your message to them other than saying, look, we told you so?
Yeah, I think clearly the message is, come back into the market on two reasons. One, the effort that is being put in by the policymakers is not going to be left halfway. I think it's going to be a long-lasting effort that they are going to put it. And given the fact the recent policy, despite inflation being considered as one of the worrying factor, the governor, in fact, has made a point very clear that despite inflation being there is no room for we to consider interest rate hike. Means they want to provide all kind of support to get the economic growth back to normal. And also one has to keep in mind, for HNI, especially for HNI's point of view, global investors, I was just looking at the number, year-to-date investment by FIIs is $17 billion. The last 3-4 months is close to about $7 billion. India has been the second largest recipients next to Japan on the foreign flows. And the global now investors have started predicting next 10 years of emerging market bull. If that's, I think, going to happen in real sense, then India would be one of the biggest beneficiaries of that. Therefore, from HNI perspective, and rather than trying to time the market, and they should come in whichever schemes are suitable to them and look beyond 2021, 22 from the investment point of view.
Right. Dr. Purohit, how would you deconstruct this, putting on your academic hat, when you look at the behaviors and you look at the trends, and then finally, as investor behavior, How would you decode what has happened, and what is it that investors should now look forward? So we know the basic rules of investing, that stay invested, but having seen what has happened, how would you today look at what investors should do?
Every investor must know that whatever investing the person has been doing, whether it is equity or others, should be aligned to the personal financial goals. So that is the first thing. Now, somebody who is sitting on a lot of cash should immediately come back and can start investing. Maybe it can be through the SIP. And if the person would like to invest for long term as verified by the personal financial goals, may also wait that in case there is some dip in the market, and in those kind of scenario, the person can invest a little more. So as soon as possible, the amount can be invested. And there I would like to mention that people have a lot of confusion as to where to invest. They lack the expertise. They do not know what is the right way to diversify. And sometimes there are so many people that make some or the other prediction. There is so much of the noise, and there is a forced activeness in which the retail investor gets into. And but now, thankfully, we have the mutual fund industry, which has matured. It's a big industry and doing so well. So through the SIP mode, those with a lot of cash can come, and one should not try to predict what will be the market after 2 months, 3 months, or 6 months, but stay invested for a longer term. And I'm saying this in the backdrop of the fact that very few investors can afford to follow an active investment strategy. And it is always better to choose the right scheme and stay long term with the mutual funds. And before following the active strategy, one should have the expertise and the wisdom as measured by the combination of reason and intuition. Now, even then, the prediction and the real picture would have a gap. So if you talk about the retail investors, the scenario, as far as they are concerned, they might not take the right decision. So better to invest and go through good mutual fund schemes.
Right, right. No, absolutely. Mutual funds have done extremely well, and that is really the retail vehicle in India. Bala, what holds back real estate mutual funds? Because I know that SEBI regulations actually allow mutual funds to offer a real estate mutual fund, just as you have a gold fund or you have a debt fund. Again, we've had a lot of change in real estate happening. A lot of the extra exuberance and the gas has come out, and RERA in some states has been positive. So for an investor who doesn't want the clunkiness of actually owning that piece of land or flat, I would imagine that for my real estate allocation, I would love to have a mutual fund. Why does the industry not provide that?
Yeah, again, it's been development for quite some time, both at the regulatory level as well as in the product conceptualization level. I think the REIT is the best way the mutual funds can actually participate in the real estate segment. A REIT, of course, is not a very long established instruments in India. At each point of time and each year, both the government and the regulation have looked at the pain point attached to it and removed all the hurdles so that this instrument can get developed. But having said that, of course, the REIT has got three components. Any REIT or InvIT has got three components, which is the capital gain, which is the underlying price movements of the underlying securities. Second is the dividend that is being declared, and third is an interest income. And interest income is actually quite simple, whereas dividend income is subject to the new taxation, and also the capital gain is subject to how the underlying price movements of the underlying property is. In these kind of scenarios, there is an element of price fluctuation that comes because it's listed in the market. Sometimes I know very well that I am coming into the instrument for 10-year investment, therefore I can stay invested. And looking at the price fluctuation that happens in the market, price discovery happens in the market. So far, the price discovery has been more on the negative side rather than the positive side. So I would assume the market has to get more developed or rather matured on this phase so that investors understand this price fluctuation is not something should be a showstopper. it should actually look at actually the whole length of the period for which I'm making investment and ignore the price fluctuation in between. Unless until they want to sell the instrument, then it can get developed. The mutual funds, of course, have to play a role. I would assume the soon mutual fund would start playing a role on this phase through an AIF structure, clearly with the closed-end kind of fund. There is an opportunity. Of course, regulation also has to look at making a single investment REIT, a single issuer REIT, or InvIT, so that we don't need to worry about too much diversification in the REIT business. When the underlying instrument itself is diversified across different asset classes.
Right. Okay. So just closing comments now, Dr. Purohit. A lot of times we want to understand not just from the metrics of data, but the metrics of our sense. So we talk about it saying mahal kaisa hai? How do you feel? So how would you, when you sense your students and your faculty in this very large university, how would you feel that people are thinking about the future in terms of their prospects, in terms of their money? What is your deconstruction of this?
Yes, Monica ji, I think the last few months have been very much testing, and everyone is hoping that this all Corona and the COVID is all over as soon as possible. Now, in the terms of their outlook, they are very much optimistic about the things to happen in the time to come. And now, talking about the markets, how the markets have been going right now, I think that when Nifty was at 6,000, people were waiting for 4,000. When it was 7,500, people were waiting for 6,000. Now it is about 13,400. People are waiting for 10,000. So I think these things are going to continue. But as far as our university, Banasthali, is concerned, and the people over here, we are quite optimistic. We are going to get out of the phase very shortly. And I think next few years are going to be really very, very bright.
Okay, that sounds very nice. Bala, when you talk to your distributors, so they are really the guys on the ground, the entire IFAs, the distribution arms, and through them you hear customers, you hear the investors. So that's on one side. On the other side is really, as a business, you think about investing, you think about the future, you think about outlays for the future. What are you picking up? What is it that is you're on the ground? Let's not talk of data, but you do get a feeling of whether things are good or not.
Yeah, I think things are, I think coming back, I would say the confidence is returning. And people do have a disbelief about 4 or 5 months back. The way, I think there's one thing which I think people are underestimating, the power of the regulatory changes. Everyone underestimated, and that's something now is being realized. That's something what they see, we are seeing an impact. And if I have to say, give one instrument in which where the rates are the lowest today, it is on the housing loan segment. It's actually one of the lowest in the history of Indian real estate sector. Those are some is a real. We cannot actually ignore it, and you cannot say neglect it completely. That something is being seen as real. And therefore, the ground level, while things are getting better, but from the investors' point of view, having now seen such a pickup in the market, and most of the people have also missed investing in the rally. Therefore, there is a feeling of what should I do? There is a dilemma. This is where I think ultimately same mantra which has been tested multiple number of times in the past. People are now coming back to the same mantra in terms of giving the asset allocations and SIP as something. I think it's just coming back. But definitely I can say in the last 6 months, while the industry has grown in terms of size, when FIs are putting money in the country, or domestic investors are redeemed, which is what they were waiting for, putting money in India. So most of the overseas investors always asked one question: when will guys stop putting money in Indian equity? Therefore, we can start coming in. Which has come actually unfortunately during the COVID period.
Right. Absolutely. No, this is fascinating, and I'm hoping that people watching do get some insights about what to do with their money. And I want to thank you, Dr. Harsh Purohit, so much for sparing time, and Bala for talking to investors and taking us through various things, macro and micro. Thank you all very much.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.